A few videos ago, we looked at adding to lot size after wins to take advantage of strings of winning trades. This video will look at the inverse of that, if you will, and that is adding to lot size as winning trades go your way. Greetings, my fellow tradecrafters. Welcome to this episode of Tradecraft Solutions. I'm Robert Donovan. Adding to a position as it goes your way is referred to variously as pyramiding, scaling in, averaging up, and grid trading. They all boil down to you pile onto a trade while it goes your way because you're not sure when the next good trade is going to come along. It is best used for systems with less than a 50% win rate and an average win to average loss ratio of somewhere around 2 to 1. It doesn't have to be exactly 2 to 1. It can be in the high 1.7, 1.8s. Higher is better. We're going to be applying a basic pyramiding strategy to a no-nonsense Forex style trade, and we're going to be using the prop firm challenge specs for the Fiverr's $40,000 account, which is their prop firm challenge account that's their most popular. It's a $10,000 starting account size, a 4% max loss, a 1.5% max risk per trade. To do this, we need to decide on how much we're going to risk initially. We don't want to risk the 1.5% max because since there's only a 4% max loss, 2 or 3 losses in and we've blown the challenge. So I'm going to go with 0.4% initial risk per trade to give us 10 losses until we hit 4%. As always, this is my opinion only, not financial or investment advice, and you should believe nothing that I say until you have tested it with your own systems, strategies, and backtesting. We're going to be using a notional risk model in this example, and that is we're not going to be using the 1.5% as our actual risk. We're going to use it as the basis for a formula by which we calculate the risk we actually do put on. This is going to be a little bit riskier than the 2% fixed fractional approach that is normally taken for no-nonsense Forex, but it is far less risky than doing the straight risk model of starting off with 1.5 or 2% in an account that only lets you lose 4. It also allows you to tailor the risk to your preferences. So let's go to TradingView. We're going to open up the Euro-USD chart. One of the first decisions we have to make before we even start trying to pyramid is we need to decide how often we're going to add or how quickly we're going to pile on each additional tranche in the pyramid. I have decided to use 1/2 of 1R. 1R is the distance between the entry point of a trade and the initial risk stop loss. So in this case, on the 7th of April, the SSL-12 crossed over, the DPO-20 was positive, and the Wadiata explosion was positive and above the explosion line, and it signaled a buy at 1.1863. The ATR was 67. No-nonsense Forex strategy calls for a 1/2 of 1 1.5 ATR, as an initial risk stop, which gives us 101 pips. We're going to call half of that as 50 pips, and that is our 1/2 of R value. The next decision we have to make is the tranche sizes we want to use. Since 1.5% is the Fiverr's max risk limit, and we are already risking 0.4% if a trade gets triggered, then it makes sense to me that we go 0.6 for the second tranche. So we'd add $60 risk there, and then another 0.5 or $50 risk added to the trade when we get another 50 pips up after that. You don't want to get carried away of adding tranches because the chance of a tranche or the price going against you as you increase the tranche, those chances go up with every tranche you add. So on the 7th of April, we got a signal to enter long at 1.1863. And if we do the math, we discover that 40 divided by 0.0101 is 3.960. That gives us 3 lots because we can only trade micro lots at the Fiverr's. We cannot trade nano lots. So if we put this trade on, we would put a stop in at 1.1762. If the trade was never profitable, we would be out $30.30. You would enter this tranche at the market or on the close as normal for the no-nonsense Forex strategy. Once this trade is confirmed and running, we are going to place immediately 2 additional pending buy stop orders. Okay, so for the second tranche then, we are going to we're going to go long an additional 5 lots at 1.1913 with a stop at 1.1813. You divide 60 by 0.0101, you get 5 lots. It gives you 5 lots. If that order gets filled, we are going to move the tranche 1 stop up to 1.1813. The third tranche will be long 4 lots additionally at 1.1963 with a stop at 1.1863, and we would move the stop on tranche 1 and tranche 2 at that point to 1.1963. So when we look at the risk profiles we have set up here, then on the first tranche we are risking $30.30 or 0.3%, 0.3%. When tranche 2 is triggered, which happened on the 8th of April, we would have still had 50 pips worth of exposure on the first tranche because we moved the first tranche stop up to the stop for tranche 2, which was at 1.1813. That still means that if the market falls to that stop, we'd be a 50 pip loss on tranche 1, which works out to $15 or 0.15%. Risk on tranche 2, of course, would be 5,000 times 101 pips, which would be $51. So that gives us a total risk of 0.66 of 1%, 0.66. And on the 14th of April, tranche 3 would have been triggered, and we would have placed our stop at 1.1863 for tranche 3 and moved the stops on the other 2 tranches to that level as well, which puts us at 0 risk for tranche 1 because that's where we got in. And on tranche 2, we would still have 50 pips risk left, which would be 0.25%. On tranche 3, of course, we would have the full risk on because we would just have put it on at that point. That's 4,000 units of currency, 4 microlots times 101 pips would be $40.40. So we'll just call that 0.4%. And we now have 0.65% is our total risk on the account. So we're nowhere near 1.5%. You could keep going and keep adding tranches. But again, there's a trade-off there. The more you add tranches, the greater the chance that the tranche you add next will be the one the trade starts to turn around on. So that is the risk you take if you keep adding tranches. We're just going to stop at 3 for this example, because if the market continues to go our way, then the risk will start going back down. So we're going to use the trim, trail, and hold approach for the rest of this trade. At this point, you treat it as if you were doing a standard no-nonsense Forex trade in that you set a profit target of 1 ATR from the entry point for tranche 3. If that profit target is hit, then you would sell half of each tranche, move the stops up to break even, which in this case would be the entry point for tranche 3, and then trail a 1.5 ATR stop and hold it until it is hit. So that is the basic method by which you do a pyramiding strategy. The idea is that each time you add a tranche, you move the stop up on the earlier tranches to keep the risk contained. But we'll get to that in a minute when we talk about the pitfalls and precautions. The first pitfall and precaution you want to avoid is understand that some prop firms don't allow pyramid trading strategies, so you want to check first. The other thing you want to keep in mind is that starting capital matters. Our $10,000 account got us a measly 3 microlots starting position. The $40,000 account is the most popular one. It has a $10,000 starting account size, 1/4 of the account you'll get if you pass the challenge. They have an $80,000 challenge at the Fivers as well, and if you can afford that, then I would recommend getting that. You're trading 0.4% of 20,000, which means that your lot size would be twice as big, which means when you're right, you're making twice as much money. The percentages are still the same, but you'll find that if you get a big win, the more lots you can buy, the better off you are in these challenges. There is also a problem with using this particular strategy in that it requires fairly strong trends and high volatility in order to work well. You could try to overcome this by saying, okay, instead of adding a tranche at 50 pips profit, I'll add a tranche at 25. Put the tranches on faster. The trade-off there, though, is that every time we add a tranche, we're moving all the other stops up, but because we're adding a tranche at a smaller pip target, we're also moving the stops up on the earlier tranches less, so you're keeping a much higher risk on the trade for longer that way. But it does get you your whole position on at a lower average price, and it does somewhat overcome the fact that you need a pretty big move. It needs a smaller move at 3 tranches of 25 pips than 3 tranches at 50, or 2 tranches at 50. So that is something to consider. It's part of the way you can tailor the risk to your preferences. The other thing about this that you want to keep in mind, or the fourth thing, I guess, that you want to keep in mind, the type of strategy you tend to use pyramiding with tends to have strings of losses and a few really big winning trades per year. Missing even one of those really big winning trades can not only wreck your chances of passing the challenge, but even if you pass the challenge, if you use this for your daily driver as your trading vehicle, once you pass the challenge, you are paid for performance when you work for a prop firm. So missing one good trade like this can really wreck your annual performance, and that can cause you to give yourself a pay cut, as it were. Other problems with this would include, I guess this would be number 5, increasing risk on a trade in progress can be a little scary for some people. That may be a psychological hurdle you have to work on getting over. Another phenomenon that you tend to run into with the type of system you tend to use this kind of money management strategy with is the fact that if you have a win rate that is significantly below 50%, say in the mid to high 30s or the low 40% range, in those circumstances, not only do you not want to add to your lot size after a win because your next trade is significantly more likely to be a loss, you may want to develop some rules for waiting for a loss or two before you take the next signal. The Turtles actually had rules like this in their strategy. I've got a link below for the Turtle strategy if you want to see how a strategy like this was traded. The last thing I want to talk about with this is that bigger risk equals bigger drawdown, regardless of your strategy. In every one of these strategies where we are adding to risk per trade, if the market fails to trend, we are going to lose more money than we would with a straight fixed fractional trading strategy, as is recommended by No Nonsense Forex. But that is the inexorable connection between risk and reward. The key is not to get reckless about adding more risk to your trades. So that, folks, is straight pyramiding. Next video on this topic, we're going to look at combining the 2 methods we've looked at already. The per trade martingale approach, where you add to your risk after wins, and the trade in progress pyramiding approach that we looked at in this video. And we're going to use them on the same No Nonsense Forex trade. Thanks for watching. If you've lasted with me this far, still working on the coin flip trading videos. They are coming, I promise you. If you found this video useful and think others might, please like, share, and comment. And as always, until next time, may the balance of your day be awesome.